Hi, this is Claire Anholt, and these are your self-storage market insights for April 2021. As the first quarter came to an end, storage fundamentals continue to perform very well, and the industry continues to ride demand tailwinds created by the pandemic. In March, street rates across the country continue to trend upwards, and development is yet to experience a major slowdown. While the outlook for storage looks very bright, some remain cautiously optimistic. As the economy continues to recover, it is unclear if demand will be sustained or if waning demand could potentially intensify the supply headwinds storage will likely face in the long term. Among the top markets tracked by Yardi Matrix, the Inland Empire once again saw the largest percent increase in street rates for standard size 10 by 10 non-climate controlled units in March, up 7.0% year over year. The Inland Empire also led the top markets for street rate growth of 10 by 10 climate controlled units over the last 12 months, seeing an uptick of 9.0% in March. While San Jose and Miami made the top 5 markets for non-climate controlled and climate controlled rate growth. As previously mentioned, storage properties under construction or in the planning stages nationwide accounted for 8.4% of existing inventory in March, a slight rise from February. Despite the mounting costs of construction materials, the national new supply pipeline remains strong. As the Self-Storage Association reported, the price of steel surged nearly 50% over the 6 months from September 2020 to February 2021. Steel framing makes up roughly 20 to 25% of a new facility's construction costs, and is already one of the most expensive components of a new storage building. So its rapid rise in price could potentially hinder projects. However, developers do not seem to be deterred. New York continues to be a hot metro for new storage development. Despite adding over 3.3 million rentable square feet of new storage construction over the past 12 months, New York continued to see development activity increase across the metro in March. Self-storage properties under construction or in the planning stages of development is equal to 17.7% of existing stock, increasing 60 basis points month over month. Although New York continues to lead the top markets for development, when it comes to the square footage available per person, New York is the most undersupplied market, offering 3.5 net rentable square feet per capita. Due to the low amount of storage available in New York, it's no surprise the metro's street rates are amongst the most expensive. So a large amount of added square footage is a welcome addition. With its existing inventory equal to 11.5 net rentable square feet per person, nearly double the national average, Charleston has notoriously struggled with downward pressure on street rates. In March, Charleston showed signs that demand has finally started to catch up to the excess storage supply, and street rates had their best performing month in over 3 years. Street rates for 10 by 10 non-climate controlled units grew 3.4% year over year, while rates for 10 by 10 climate controlled units increased 3.5% annually. Another market overcoming the struggle of oversupply is Houston. The Texas Metro also saw record street rate performance in March for both 10 by 10 non-climate controlled and climate controlled units. Year over year, street rates for 10 by 10 non-climate controlled units increased 3.6%, and rates for similar sized climate controlled units grew 5.0%. For both unit types, this was the greatest growth seen in Houston since June 2017. Due to a lack of citywide zoning laws, Houston was early to this last storage development cycle, and street rates have been hit hard over the past few years due to heavy new supply. While the pandemic continues to strain Houston's economy, strong growth in population and job migration in recent years has helped the local storage industry slowly reach more of a supply-demand balance. If you found this video helpful, please remember to like and share. Thank you.